The Dow is soaring into record territory after Federal Reserve Chair Jerome Powell forecast changes could be on the way.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data.
Jerome Powell just gave the green light at Jackson Hole, and markets went wild. Stocks exploded higher, pushing towards new all-time highs. But here's the kicker. The last time we saw a setup like this was back in 2007, right before the financial crisis. And we all remember how that one ended. Stick around until the end of this video because I will show you why the 2007 parallels are impossible to ignore. Here is what we are diving into today. What Powell actually said at Jackson Hole and why the market reacted the way it did. The crack showing up in the housing, real estate, and consumer debt. While retail money is flooding into a 5-to-1 pace compared to funds, and why that gap matters more than most traders realize. And finally, why today's setup looks exactly like a replay of 2007 and 2008, and why that should worry every trader. Alright, let's dive into this. Powell's speech was full of caution, but markets didn't hear caution. They heard rate cuts. In the first hour of trading, stocks reversed the entire drop since last week and pumped all the way to the all-time highs. Tech and small caps led the way, even crypto and meme stocks spiked. It was a full-on party. But dig into what Powell actually said, and it wasn't bullish at all. Payroll growth has collapsed just 35,000 jobs per month compared to 168,000 last year. Unemployment ticked up to 4.2%. And GDP growth slowed to 1.2% in the first half of 2025. That's half the pace of 2024. Consumer spending weakened and immigration slowed, cutting labor force growth. Powell even described the job market as a curious balance, with both supply and demand cooling. Translation: the labor market is slowing, but not in a healthy way. Inflation isn't solved either. Headline PCE is at 2.6%, and core is 2.9%. Tariffs are pushing prices up, which Powell called a one-time shift, though he admitted there is a risk of wage price spiral where rising wages keep pushing prices higher. Still, he emphasized that longer-term inflation expectations are still holding steady around 2%, which keeps the Fed somewhat confident for now. Policy-wise, Powell noted the Fed funds rate is now 100 basis points closer to neutral than a year ago. He said, and I quote, "With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our stance." That was the line that markets clung to as a signal for rate cuts. But he made it clear, every move will depend on incoming data, so no preset path forward. This is exactly what I warned about a few weeks ago. In my previous newsletters and videos, specifically a few recaps back, I said the Fed was boxed in and September could be the breaking point. Fast forward to Jackson Hole and that's exactly what looks like might happen. So let's talk about where those cracks are already showing up. Housing is a prime example. The typical household now needs nearly double the median income to afford a medium-priced home. At the same time, prices are falling in nearly 40 major metros. That's demand breaking under pressure. And here is something we've never seen before. New homes are now cheaper than existing ones. Historically, new builds always carried a premium. But today, builders are slashing prices just to move inventory. That's how stressed demand has become. The last time we saw anything close to this kind of distortion was right before the 2008 crisis. Commercial real estate looks even worse. Office vacancies are at record highs, nearly double the pandemic lows. Investors are walking away from offices and pouring billions into data centers instead. This shift tells you that the old CRE model is breaking. And stress there can spill into banks and credit markets really fast. And then jobs. Powell admitted payroll growth slowed sharply. Earlier numbers were revised lower and immigration is shrinking the labor supply. On paper, the labor market looks balanced, but in reality, it's flowing from both sides. And it's not just jobs. Look at the consumer credit. Subprime auto loan delinquencies just hit their highest level in decades. That's usually the canary in the coal mine, because autos crack before housing does. If this stress spills into mortgages, then the damage multiplies fast. I called this too in my midweek newsletter. So revisions to payrolls, weakening PMIs, it's stagflation risks all stacking up. And now the Fed is cornered. Cut rates to save the economy, but risk a new wave of inflation, or keep the rates pinned to watch the economy go down in flames. Here is where it gets funny. Retail traders have shoveled nearly $200 billion into stock ETFs this year. This is the biggest inflow on record. That's a 5-to-1 imbalance compared to the $40 billion pros have pulled out. And it doesn't stop there. Retail is also on the longest streak of option buying in years, chasing every pup. Meanwhile, institutions, they are hedging billions into protection ETFs, long volatility, and gold. It's different vibes, but the same market. Retail has been chasing the markets to all-time highs, euphoric and convinced nothing can go wrong. And hey, that's always when things feel the safest, right before they are not. So enjoy the rally, but keep a helmet nearby. Consider me the annoying friend at the party reminding you the music always stops eventually. Again, we're seeing the same cracks we saw back in 2007. Subprime delinquencies climbing, wages falling behind, and households straining under debt. Credit spreads still look calm, but only because liquidity is masking risk. When that fades away, stress comes out fast. It's the same setup we saw before 2008. And what about the valuations? The S&P's forward PE is back at dot-com levels. We are paying record prices for slowing earnings growth. Powell himself admitted GDP is barely over 1%. So this is where it all connects. In 2007, on September 18th to be exact, the Fed cut rates. Stocks went higher, making new all-time highs. Everyone was euphoric. But housing, debt, and credit were already breaking. And just months later, the crash hit. Here in 2025, Powell hasn't cut yet, but markets are already pricing like he has. Housing affordability is collapsing. Commercial real estate is in crisis. Consumers are stretched to the breaking point, and valuations are stretched. If cuts come, asset prices can melt up even more. Meme stocks, crypto, small caps could all run. But cuts won't fix fundamentals. They risk fueling inflation, inflating bubbles, and crushing the dollar. On paper, you might look richer, but your buying power keeps shrinking. And this isn't new. I flagged this exact risk a few videos back in my hidden reasons you're not getting rich in this rally video. Because what the Fed will do next isn't just about markets. The dollar is already weakening, and if they cut, it will only sink lower, which helps them manage the ballooning US debt interest payments. But that comes at a cost of your purchasing power shrinking even faster, and potentially causing another spike in inflation. That's not sustainable. Now, let's quickly hit next week's economy calendar earnings, because this could drive the next wave of volatility. On Monday, we have new home sales plus a few Fed speakers. On Tuesday, we have durable goods orders, Case-Shiller home prices, and consumer confidence. On Wednesday, we don't have anything scheduled. On Thursday, we have GDP revision, jobless claims, and pending home sales. On Friday, we have personal income, PCE, Chicago PMI, and consumer sentiment. On the earnings side, on Monday, we have Pinduoduo, Semtech. On Tuesday, we have Okta and some others. On Wednesday, we have Nvidia, Snowflake, CrowdStrike, HP. Okay, I'm not gonna list all of them, but this is looking to be like a very important day, and Nvidia will make or break this rally. On Thursday, we have Dollar General, Best Buy, Marvell, Dell, and a few other important ones. On Friday, we have Alibaba and Frontline. This week is going to be very important. Most of the focus will be on Nvidia, especially their forward guidance. So make sure you're hedged in case we get a surprise. And here's the bottom line. Powell gave the green light at Jackson Hole, and markets took off. Take away the market euphoria, and you see an economy that's about to fall off a cliff. Housing, commercial real estate, consumers, and valuations all point to cracks. Retail is celebrating, pros are hedging, and the Fed is boxed in. And you've been following me for a while, you know this isn't hindsight. I flagged this exact setup weeks ago in the newsletter and in my previous videos. Now they're unfolding in real time. And look, as much as I've been pessimistic about this rally, I've still laid out plenty of bullish trades that worked. NEO, Tempest AI, Intel, Robinhood, HIMS, Centene, United Health, and many more. All names I flagged in the newsletter that played out beautifully. That's the balance. Cautious on the macro, but tactical when opportunity lines up. So get the same playbooks I use, including the chart and technical setups not covered in this video, and any breaking news that could move the markets, delivered directly to your inbox. And when you sign up, you also get my free candlestick and chart pattern cheat sheets, with more free tools being added in the future. So don't trade blind. Join me in the free newsletter below. If this video gave you clarity, hit like so more traders can see it. Subscribe so you don't miss the next update. Things are moving a bit fast. And drop your thoughts in the comments. Do you think this time will be different, or are we replaying 2007 all over again? Thanks for watching, and I will see you in the next one.